Most traders begin optimization in the wrong place. They select a strategy, enter their entire deposit as the initial balance, find an attractive equity curve, and assume the job is done. But then they try to launch several algorithms at the same time and discover that there is not enough capital after the first averaging entries. Today, we will show you how to properly test and optimize the Adaptive DCA strategy, validate it on data that was not used during optimization, and prepare the preset for deployment in the BadRock terminal. And we will not begin with the run button. We will begin with capital and risk. In the initial capital field, you should not enter a random amount or necessarily your entire deposit. The important thing is to determine how much capital you are actually prepared to allocate to one strategy on one trading pair. Because the objective of a systematic approach is not to launch one algorithm using the entire account. It is much more reasonable to distribute capital across several strategies, instruments, and market logics. For example, when you plan to run 5 strategies simultaneously, you cannot calculate each one as though it had access to 100% of the deposit. When you plan to run 10 active presets, the capital load of each preset must be even lower. This is especially important for DC because a position may consist of more than the initial entry. You need to account for the following in advance: the initial order, every permitted averaging step, the maximum position size, the distance to the protective stop, the possibility that other strategies may open positions at the same time. In the Adaptive DCA logic, the number of additional entries is limited, the distance between them can be calculated using ATR, and the size of each addition can be fixed, calculated as a percentage of the current position, or determined using a scalable mode. After an averaging entry, the take profit and stop loss levels are recalculated from the new average position price. The main rule is simple. A potential stop loss in one strategy must not become critical for the entire portfolio. When one unsuccessful DCA cycle can seriously damage the whole account, the problem is not the market. The problem is capital allocation. A simplified calculation can be structured as follows. First, determine the acceptable risk for one preset. Then calculate the maximum possible position, including every averaging step. Only after that should you define the initial capital for the backtest. For example, with 3 additional entries of equal size, the strategy may potentially use the equivalent of 4 initial orders. When the size of each subsequent entry increases, the total capital load grows even faster. That is why evaluating only the size of the first order is not enough. In the terminal, it is better to test the strategy using the amount of capital that you genuinely plan to allocate to it within the real portfolio. Now we select the asset, account, and timeframe. On the screen, we are testing Adaptive DCA on the selected instrument through the connected brokerage account. Next, we set the historical testing interval. It is important to maintain a balance here. A period that is too short may produce an attractive result simply because the market remained in one regime throughout the entire interval. A period that is too long may combine completely different market phases and make the optimization excessively broad. For an initial test, you can use the following guidelines. For the 5-minute time frame, approximately 3 to 6 months. For the 15-minute time frame, 6 to 12 months. For the 30-minute time frame, 9 to 18 months. For the 1-hour time frame, approximately 1 to 2 years. These are not strict rules, but useful starting points. The important thing is that the selected period includes rising markets, falling markets, sideways movement, and periods of elevated volatility. There is no need to re-optimize a strategy every day. Doing so may cause the parameters to become fitted to the latest few market movements and reduce their robustness. However, using the same preset for years without reviewing it is also incorrect. For lower time frames, it is reasonable to review the parameters approximately every 4 to 8 weeks. For the 30-minute and 1-hour time frames, a reasonable interval may be once every 2 to 3 months. However, re-optimization should be performed earlier when volatility changes significantly, drawdown increases, the number of trades decreases, the strategy's behavior deviates substantially from the backtest, the market shifts into a different regime, We want the historical interval to remain relevant, but not so short that the optimizer begins memorizing market noise. Now let us briefly explain the strategy itself. Adaptive DCA is not simply uncontrolled averaging against a price movement. The strategy analyzes the market phase, volatility, trend direction, and momentum conditions. Its logic may use FODA filters, a momentum oscillator, anomaly assessment, ADX, EMA slope, and market classification into trend, flat, high volatility, and low volatility regimes. The initial entry is generated only when a valid base trading signal is present. Additional entries are not placed at random distances. They occur after a predefined price movement, for example after several ATR units. The number of DCA steps is limited. Protective levels and targets are recalculated from the average price of the entire position, and a trailing mechanism may be activated after sufficient favorable movement. In other words, the purpose of the strategy is not to increase the position indefinitely. Its purpose is to build the position in a controlled way while maintaining predefined risk limits. Before starting genetic optimization, we run a standard backtest. This is necessary for diagnostics. Whether the strategy generates trades, whether the filters are too strict, whether the time frame matches the strategy logic, whether there is enough historical data, whether the position size appears reasonable, whether the default parameters already produce excessive drawdown. When the test shows 0 trades, this does not always mean there is a system error. The selected period may be too short, the asset may not have met the entry conditions, or too many strict filters may be enabled at the same time. First, we need to understand the reason. Only then should we change the settings. After the initial test, we select genetic search and start the optimization. A genetic algorithm does not test every possible combination one after another. It identifies the most promising candidates, combines them, and gradually improves the next generations of parameters. This allows the system to explore a large parameter space more efficiently. However, even genetic optimization may take several hours. That is completely normal. We may be testing many different combinations of distances between DCA entries, the number of averaging steps, additional entry sizes, trend and volatility parameters, take profit, stop loss, and trailing settings, market phase filters, entry signal parameters. The longer the historical period, the smaller the time frame, and the greater the number of variable parameters, the more computation is required. Do not stop the process simply because it has not finished within 5 minutes. After optimization is complete, you should not simply choose the row with the highest profit. This is one of the most common mistakes. A high P&L may have been produced by only a few rare trades at the cost of a deep drawdown through excessive capital utilization during one unusually favorable market period by overly aggressive averaging. That is why we compare several metrics. The Sharpe Ratio shows the relationship between the result and the variability of returns. The stability score helps evaluate the smoothness of the equity curve. The recovery factor compares the generated profit with the maximum drawdown. Profitability shows the final return. Maximum drawdown shows how severe the worst historical period was. The composite criterion helps compare presets across several characteristics at once. For a DCA strategy, it is especially important to evaluate not only the final profit, but also maximum position exposure, drawdown depth, the number of averaging entries, the duration of an open DCA cycle, dependence on a small number of unusually profitable trades. We are not looking for the most aggressive preset. We are looking for a preset that can be safely included in a portfolio of other strategies. Next, we launch the walk-forward analysis. The historical period is divided into training and validation segments. The optimizer selects parameters on one segment, and the terminal then tests them on data that was not involved in the parameter selection. This is critically important, because almost any strategy can be made to look attractive when it is fitted to known historical data. Finding parameters that continue to perform on a new interval is much more difficult. During the walk-forward analysis, we examine whether the result remains positive, whether the drawdown increases sharply, whether the strategy continues to generate enough trades, whether the recovery factor deteriorates, whether the structure of the equity curve remains similar, whether the preset remains stable when the date boundaries are shifted. A good preset does not have to generate identical profits in every interval, but its behavior should remain logical and controlled. This is where most users stop again. They want to press launch immediately, but they do not want to spend time calculating capital, testing the strategy, and validating its robustness. That is why many people change strategies for years without ever changing their results. You do not need to watch dozens of videos and wait for the moment when everything becomes completely simple. Begin with one action. Choose one strategy. Calculate its actual capital limit. Run a backtest. Start the optimization. Validate the preset with walk-forward analysis. Systematic trading does not come from the amount of content you watch. It comes from a repeatable process. After validation, we select the most balanced preset, save it, and send it to the terminal. Before launching it, we check once again the trading pair, the time frame, the connected account, the initial order size, the number of DCA steps, the maximum exposure, the stop loss, the risk limit for the entire portfolio. Only after that do we activate automated trading. BadRock allows you to complete the entire workflow in one environment. Backtesting, optimization, walk-forward analysis, preset selection, and deployment. Do not try to find one strategy to which you can allocate your entire deposit. Build a portfolio of algorithms where the risk of every preset is limited and the capital is distributed in advance. Subscribe to BadRock Capital so you do not miss the next practical tutorials. Like this video if you want to follow up explaining how to calculate capital for 5 or 10 strategies running simultaneously. And tell us in the comments what we should explain next. DCA steps, genetic optimization, walk-forward analysis, or portfolio risk. Share this video with someone who still launches trading systems without calculating the required capital in advance. Stop guessing. Validate, allocate risk, and only then deploy. This content is provided for educational purposes only. Backtests and optimization results do not guarantee future performance. Trading involves risk,